Great. Hey, thank you, Michael. Appreciate the opportunity to do this. And as the funny thing is that I've already finished my slide presentation. So
that was an easy one.
We'll fix that. So now we're back. Hopefully you can see that, Michael, and everybody that is participating today. But we're excited to be here.
Great. Okay. Well, yeah. Thanks everybody in attendance. And just because it's the elephant in the room. Well, my name's Chris Sloan, and obviously with Alan Marsh, we're both speaking, but definitely want to, put our hearts out to everybody in Ukraine and the region with the events overnight. Very sad, very tragic. So just want to put that out there. It's an interesting and somewhat mournful day. So I want to mention that as we get into the presentation. We'll be touching on a lot of topics, the evolution of the market, and some of the features of our fund. We'll get into that as well.
Perfect. Thanks, Chris. So the evolution of fix and flip, we thought we'd kind of step through that process, but wait, not really fix and flip. It really is value add. That's where the market is really, as we see it in our business. Historically, if you look at a time period and the environment, 2000, 2005, it was just your normal, residential, acquisition and purchase and then hold and move in, move out. 2006 to 2008, there was a frenzy. The value was the purchase, right? And that's how they had that turnover there. 2008 to 2010, you started seeing a lot more foreclosures. Buy very low, sell low. That's how that turnover happened. People were purchasing homes on the courthouse steps and buying 5 or 10 a day, and then that night selling them to somebody else and then doing the same thing the next day. 2010 to 2009, that is where fix and then flip started happening. 2010 to 2019, excuse me. And initially, fix and flip was really more about paint and carpet, and then just give it a little bit of a cosmetic look change inside, and then sell it to somebody that would want to move into it. And then it started becoming a little bit more repairs and a little bit more than that. But then it turned into more of a value add where they needed to find ways that they could create additional value because something was missing. And then in 2020, obviously the pandemic hit, and then in 2021, we still see some frenzy in some areas, but our borrowers really are the value add players. That is what they're doing. So we thought we'd try to provide some transparency and clarity between understanding the difference between core real estate and value add real estate. And we thought it could be more easily explained by looking at a commercial piece to begin with. So, in commercial real estate, you would have a nice, beautiful Class A office building that somebody might have interest in. And why would they have interest in it? Well, because it's got credit tenants, long-term leases. It's got a consistent, dependable net operating income. And then there's a cap rate that's derived for that. And then obviously there's a value. So a cap rate, and as everybody understands, is just really what is the rate of return that an investor is willing to accept that they would pay for it. And that's how you would really get that cap rate, realizing the net operating income that's coming in off of it. That is how the core commercial would be looked at. So how does that differ from value add in commercial real estate? Well, you would find a building that's got a problem. Well, in this case, this is an example of one where it was a 3-building, 37,000 square foot plus medical office complex. This one happens to be in Arizona. That was purchased in 2019. And it was purchased for $6.2 million, and it was only 27% occupied. It had previously been used as a big clinic as well as a surgical center. And but now the surgical center and the large clinic space was vacant and just empty. So it was purchased in that condition. This is what it ended up turning out to look like 2 years later. Upgraded, and now is fully occupied, and with new tenants, long-term leases, a surgery center that was able to replace the old surgery center, and now 100% leased and is now sold. So 2 years later, that project, again, with 100% occupancy, 73% long-term credits, sold for 13.5 as opposed to 16.2 just 2 years earlier. So, you know, there's a value add example when it comes to commercial real estate. So as you segue into the residential side of the business, you see it's a little harder to get economies of scale when it comes to residential. Now, yes, you have multifamily as a residential base that is scalable and a little easier to scale to. But even then, it's hard because it's highly sought after. And so it becomes very competitive in the market trying to find and or purchase those type of properties. And so you're competing with a lot of institutional dollars in that marketplace. Another way to potentially do it is, well, can we aggregate large portfolios of single family residential properties? And the answer is you can, but it is also very challenging to do that. To get large portfolios of single family homes, it takes time. One group that was able to do that was a group called Treehouse, and Treehouse ended up selling their portfolio. They were buying it from the RTC, back in 2011 and 12, and eventually ended up creating a business model with Blackstone, which that company since became Invitation Homes. And Invitation Homes, at least to my knowledge, is probably the largest single family residential home owner in the country. I think they own about 80,000 homes throughout the country, and all they do is rent those homes to individuals that want homes as opposed to an apartment. Another way, again, difficult to do and achieve economies of scale, is buying a piece of property and developing that property with single family residential homes and then renting those out. But again, that takes time, could take anywhere from 2 to 3 years just to get the entitlements and the homes vertical to rent out. So those are hard ways to do it. Here's an example of one of those communities that built out 100 homes. Again, this one happens to be in Arizona, where we're located, and a development group called Next Pro Development. They own several of these types of subdivisions throughout the country, and they'll buy the land. They built 100 homes here, and then they rent them out. So we do have institutional players, or the big guys. However, there is another group of players, the tradesmen, or the little guy, right, that's involved. And how do these little guys do it successfully? One house at a time. And that's really our core business. That is our borrower. That is who we do our business with under our lending model, is to individuals that are doing these single family residential homes, one house at a time. These are actually some examples of homes that have been finished by some of our borrowers. So is there a single family residential market to do value add? Absolutely. Here's a graph that you can see as a segment from the population in red to the housing starts in the blue. And as you can see, there's a big disparity. Chris, when you see that, what do you see?
Yeah, I mean, what we see here is just it's a glut of homes with huge demand with population growth. After 08, 09, we really stopped building, but the population didn't stop growing. They continued to grow with immigration and just natural organic population growth, yet you don't have the housing supply. So this is where we're focused on. This is a great area.
Yeah. You know, another thing to consider is, you know, where are we in relation to those that are coming into the marketplace to be able to buy homes. This is an interesting graph and picture. The section in green or highlighted in green is those that are in the buyer market, typical buyer market age bracket. And then the section that's outlined in blue is the section that's coming into that market now. And that would be the millennials. And this was obviously of a 2015. So we're 7 years further almost into that phasing. So it's now moving up the ladder, and it is a larger segment population wise than what has previously been there. So that's going to continue to add to that demand of individuals looking for homes. Another graph that we find interesting is to consider is looking at, of all the single family homes that were sold and flipped, right? As it only represented about a 5% or just under 5% of the total marketplace of those homes that sold. So it's, you know, this market segment that we are involved in is a fairly small segment in the overall picture of residential real estate and the market in general when it comes to sales and purchases throughout the country. The other thing to consider is the average median age of homes that are throughout America right now is about 42 years. This particular assessment was done in 2019, and at the time it said 39 years, but obviously 3 years since then, we're now 42 years. So there is a lot of homes that are out there that have some obsolescence, I guess would be the right word to use, that need to have some updating, some beautifying. And unfortunately, there are a lot of homes that aren't even maintained during that whole time frame, let alone just obsolete as far as their uses. So, you know, what are the considerations that a buyer considers as they're looking at a home? And yes, these buyers end up being our borrowers, but one of those areas is functional obsolescence. And an example of that would be the kitchen. You know, is it conducive to today's user and family? The layout of the home, are the family rooms large enough for the gathering space, or is the laundry room, is that functional, or is it outside? They need to bring it inside, some of those type of things. The physical obsolescence is another thing to consider, the size of the home. There are many times that they'll increase the size of the home by adding square footage because the lot is plenty large enough to do so, and they'll add on to the back, and they'll expand those homes out by blowing open and out some of those rooms to create additional size, whether it's square footage or just even number of bedrooms. And that's another one, number of bedrooms. Is there enough bedrooms in that home to meet the demand and the need that's going on in that area, in that community? And then lastly, looking at the exterior, the look, the curb appeal, you know, when people drive by. So as our borrowers go through this process, and you know, the first thing that they do, or one of the first things that is done after they purchase a home, is they have to go in and do some demolition. And so they're actually deconstructing, devaluing that asset, before they can actually increase the value and add value back into that home. And, it's one thing to know, but it's another thing to understand that and to plan for it and to work that into your model as you're creating your portfolio of homes that you're lending on throughout the country and throughout the areas that we try to stay active in, so that we don't, an example of that would be to make sure that we don't have every home that we've lent on is at the bottom of this J curve in the second month at the same time. That would be a poor planning on our side, right? If that happened. But it's something to always consider and to recognize. So here's a home that was purchased by one of our borrowers, and this is what that room can look like at the bottom of that J curve, right? They ripped out everything in there in that kitchen. This is how that kitchen turned out. Same home, the family room, just gutting everything out and opening it up, and then now creating a new work or a new living environment, living space for that home. So it's important to consider all those avenues and areas when they borrow or take a look at these homes. Here's a nice quote that we got from one of our clients. Value add is more than just a bucket of paint and new carpet. We are changing the face of the community, improving it one home at a time, which leads to better things for the entire community. And I'd say that pretty much sums it up, in a statement of, what, the whole intent and purpose of what we're trying to do. And so how do we help in that whole process? One of those things that Boomerang does is be there, boots on the ground, meeting with our borrowers, talking to them, going to their sites, and understanding their needs, but also helping us understand that market and what is happening in the area to make sure that there's a value and a purpose and an end to what is planned to be done on that home. With conventional lending, typically you would have a person on the left, upper left, that has that needs to borrow money. They would go to the bank on the left, and the bank would say, great, what type of business do you have? And, well, I have a manufacturing business as an example. And they say, great, we'll lend you money on the cash flow that's coming off of that lending on that business, that manufacturing facility. And we'll go ahead and give you some money so you can go back in and reinvest in your business or some other assets that you need for either the company or other purposes. Well, that's not the way this business works. The first thing that we can recognize is that a borrower that is coming in is looking to borrow money to correct and to upgrade a home. There is no cash that's being generated on that asset at that time. In fact, it takes cash, right? So when you consider this hard money lending, which really is not hard money lending, it's asset-based lending. That's what we're lending on. We're lending on the asset and the end value, the after rehab value of what that home will be in that little marketplace. So now when you look at that picture, we have a borrower that is looking to buy a home, to invest in it, top left. He goes to a bank, us, or a lender like us, and to buy a home in the bottom left and to beautify it, upgrade it, reposition it, and create additional value to have the home end up looking like it does in the bottom left, right, or the bottom left. And so it's a free flowing from the borrower to us. The money then goes into the home and then it turns to look like a finished, beautiful home in that neighborhood. Chris?
Then, yeah, I'll talk about this. So obviously there's a huge market. There's an appetite out there. There's an opportunity that we can take advantage of. And there's a lending market that is perfect. And a lot of that is what we want to talk about right now. So what we do at Boomerang, and I think you can think of these as risk mitigating factors as well. And I'll explain what that means. So first of all, we originate all of our loans. So we originate. What's great about the lenders that we have in-house is a lot of our folks, our lenders, have gone out there. They've done a lot of the value add properties. They've done that themselves. They know the trades, they know how to do it. So they know how to underwrite, they know how to, originate, they know how to price these deals as well. Also, so that's a big deal, is to find our own stuff, go out to the marketplaces, meet them, understand the market, understand the borrower, understand the borrower's need. Then it turns over to the underwriting, which is huge. We have in-house underwriting that goes and outside underwriting as well, broker opinion of value, other desktop appraisals, things like that we look at, and then intense in-house underwriting, both from our lenders, the principals. We all look at what's going on, how this can pencil, what the budget might be, and all of that. So underwriting is huge. Again, it's another risk mitigating factor. And then positioning, well, it's great to buy a bunch of loans or make a bunch of loans. What we really want to do, though, is we're building a portfolio for maybe yourself, maybe your investors. If you're an investment professional out there in the audience, we want to build a portfolio. So we have that in mind. And Alan touched on that a little bit ago. We want to look at things of considerations are where are they in the J curve? How much money is being lent to individual borrowers? Do we have a concentration of borrowers? Do we have a concentration of geographical issues? What states are working? Some states are really solid and continually going up or moving very steady. Other states are more volatile. We want to consider all these factors because, again, it mitigates the risk in the portfolio, which is what we're really looking at. When you look at Boomerang Finance, our fund, that's key. And lastly, servicing, and a lot of other folks that I know of outsource the servicing. And the servicing, and I think that's a huge mistake. Now, they do fine, and I'm not knocking on anybody, but we like to keep our fingers on the pulse of the market. When we do servicing, we know who's late and why, and it gives us a heads up as to if what problem might they be having, or how can we solve that problem if it does become something that we have to mitigate or remedy even further. So all of this, I think, in my mind, if you're thinking about this as an investment for potential clients or yourself, this all goes to mitigating risk. And then just to sort of wrap it up and go to your questions. So if you think of using Boomerang Finance, the finance fund, I think of a few things. First of all, market volatility. For the last 10 to 12 years, we've had low rates. The bond market's been rocking. It's been doing extremely well. Of course, I don't have to tell anybody on the call about the equity market doing extremely well. All of that has been great. Now, you've seen a little bit of a change recently, very recently. January has been a challenging month. February seems to be comments I made at the top with things, geopolitical issues. It seems to be a continuing trend of volatility. So where can you put your money? Where can you get a steady rate of return with solid, or at least a good degree of relative risk management? So what we look at and what we've got with Boomerang Finance is a 5-year track record. We started this in 2017, all right, June, July of 2017. So 5 years, got about an average of, it should say AUM, but it's about an average assets under management of about 140 million. All right, so 140 million in the fund, 5-year track record. Here's something else I want to make I make a big deal of this when I'm talking to folks because I think it's huge. Given that we're paying roughly between a 10 to 12% distribution, 10 to 12% distribution, folks look at that and they think it's, well, gosh, that's a lot of risk. Well, when you think about how we have first lien position, I won't get into that too much. If you have questions on that, we can talk about it. But we have first lien on these properties, and typically other properties that are non-owner occupied. They might be cross-collateralized. So that's a big deal. Again, that's all about risk mitigation and protecting the principal. But I left out duration here. I just mentioned the word. Our duration right now across 500 loans in about 12 different states, 500 loans, is about 3.6 months. So we're not taking yield curve risk here. This is something, there's a lot of velocity in terms of the loans being repaid and moved. The money's moving fairly quick in the portfolio. So I'll leave it at that. If we have more questions, we can get to it. But I just wanted to state that I would look at this as something, if I'm building a portfolio as a financial advisor, a financial professional, or even just an individual client, I'm looking at this as something that may replace a part of my traditional fixed income, potentially even some of my equity exposure as well. With that, we'll go to questions that you might have. And if we don't have any questions right now, feel free to reach out to us as well offline.
Michael,
Yeah, we have a question right here. It says, with
Okay,
servicing, this is Jeremy. With servicing, you get what you pay for at Essex. We are highly collaborative with our 50 clients. That was Chris Baggett. So let's see.
Yeah, the one, and not trying. Again, I don't think Chris was trying to talk down any type of servicers that are out there. But what we have found is that as we are involved all the way through that process of originating, underwriting, loan funding, and then through servicing, we're able to have those touch points all the way along, and we're able to keep in constant contact with them, especially as we're doing the draw requests. We can see and feel what's happening with that loan specifically, and make sure that if there is any type of things to worry about or start to come up as any type of red flags, we're catching them or seeing them earlier in the game than later, so we can get those addressed and taken care of before they become any type of a problem.
Yeah. We have another question about the fund. What are the returns?
Roughly 10 to 12 is our guidance. And I think 10 to 12%, that's an annualized rate. We can pay it monthly. Some folks like it quarterly. A lot of our clients heretofore have just simply left the money inside the fund to let it compound, but we're able to distribute that monthly as well. I think last year we're, call it low to mid 11% range.
Correct.
And that's again an annualized number which we can distribute monthly.
And that's a net basis,
Yeah.
after all expenses and fees, etc. That's what the investors are receiving.
Okay, John wants to know if this is done with leverage or no leverage.
There is some leverage that we have on the fund. So, the fund has under the PPM some guidance and restrictions of how much that we could potentially have. But typically for every dollar of equity, historically we've been running right around another 50% to 55% of debt on top of that. So not very heavily levered at all. And so when you consider that amount of leverage dollar amount wise to the overall asset value of the portfolio, then it starts to end up being really low on a percentage basis.
Okay, Neil wants to know, how long does the money stay in?
I'm assuming that the question is in relating to the investment itself, and the PPM calls for and allows for a 1-year original lockup provision, and then after that it's just a matter of providing notification of as far as remediation of when you would like to pull out any funds if you would like to. Many of our investors, historically, they'll just come to us and say, hey, I've got a tax consequence I need to pay. And they'll just give us notification, and we'll go ahead and take care of those with those remediations of those funds. So
Yeah, and let me just piggyback on that comment, Alan, as well. So yeah, it's a 1-year hold, and after which you saw, I mentioned at least a 3.6 month duration. Now it could be three months to 6 months, but right now we're running at about 3.6. So you see the velocity of the money changing hands and turning over. So usually we say 1 year lockup. That's kind of a hard and fast rule. And then after which you have it on a monthly or quarterly basis, we can usually accommodate that given the again, I hate to keep using the phrase, but the velocity of the capital moving through the fund vis-a-vis the different loans we have that pay off fairly quickly.
Okay, last question from Neil Brown is, what's the minimum investment amount? And then why don't you give everybody your contact information and we take it on out?
Yeah,
Right.
absolutely. 100,000 is the minimum. It's a Reg D structure, Regulation D. So it is for accredited investors. So 100,000, and then we're in the marketplace. There's a lot of details there as well. And I'll give my email. So I'm Chris, CHRIS, and last name Sloan, SLOAN, at boomerangcapital.com. And Alan, you want to?
yeah. So, and then same information. So my email address is Allen, ALLEN, at boomerangcapital.com. But yeah, thank you, Jeremy and Michael. We appreciate the opportunity to visit and provide some additional insight to value add and how that affects the single family residential market.
Yeah.
So thank you so much.
Thanks for the good questions too. Appreciate
Thank you
that.
so much. And we look forward to hearing more from you guys over the year. So everybody stay tuned.